Since all of you have chosen accounting as your subject, let's learn what is exactly accounting. Accounting is the process of collecting, recording, summarizing, and communicating financial information. That is, you need to collect the information, then you need to record it somewhere, then you need to summarize it, and finally communicate it to the user. So 4 steps: collecting, recording, summarizing, and communicating. Communicating what? Financial information to the users that will help them in their decision making. So my quick learn formula is accounting is CRSC, that is collecting, recording, summarizing, and communicating what? Financial information. To whom? To the users, that will help them in their decision making. Now one more thing, that accounting will always be concerned with the financial information, the commercial information. Anything which has nothing to do with money will not be included in accounting. All money measurement concept has to be taken care of. Okay, so moving on to the next slide. Define bookkeeping. What is bookkeeping? Bookkeeping is an art. What kind of art? Art of recording the monetary aspect of commercial and financial transactions in the books of your accounts. So bookkeeping is an art of recording monetary aspect of the commercial and financial transactions, means all those transactions that has to do something with money, either money is coming in or flowing out, or such transaction that will ultimately enable that money will come in or flow out. Such transactions are called your financial transactions. So recording the monetary aspect of commercial and financial transaction in the book of your accounts is called as bookkeeping. Okay, one must understand that the term accountancy is wider than the term bookkeeping. That's true. Only one part of accountancy is bookkeeping. Bookkeeping is smaller term and accountancy is a wider term. Accountancy includes bookkeeping, that is bookkeeping is subset of accountancy. You can see through this diagram that accountancy is wider term than your bookkeeping. Bookkeeping is actually included in accountancy. Now, what is a business transaction? Important point, business transaction BT means a financial transaction that can be expressed in terms of money entered into by two parties. So first of all, it has to be a financial transaction that can be expressed in terms of money. Say the quality of a labor will not be recorded in books of accounts because can it be expressed in terms of money? No. So only the financial transaction entered into by two parties, there should be two parties, for example a buyer and a seller, a service provider and a service receiver. For entering into business transaction there has to be two parties and is recorded in the books of accounts. Anything which is not recorded will not be a part of your business transaction. So finally the definition or the meaning will be financial transaction entered into by two parties and recorded in the books of accounts is called as your business transaction. What are the characteristics of business transaction? It has to be concerned with money. If there is no monetary aspect, it is not a business transaction. and there will be two parties. So for two parties, it has to have a dual aspect, that one account will be debited and the other account will be credited. A business transaction brings change in financial position of the business. See, either my cash will increase, my cash will decrease, or my creditors will increase, my debtors will decrease, my purchase may increase, it may decrease. Same for the sales, same for the stock. So in any way, when a business transaction takes place, the financial position of the business changes. So remember that for a business transaction, it has to be a financial transaction, FT, financial transaction. There has to be two parties. So TP and R stands for your recorded in the books of accounts. Business transaction means a financial transaction entered into by two parties and recorded in the books of accounts. No need to mug up, just see this clip 2 or 3 times and you will learn it by yourself. Your mind will start getting programmed in that manner. Okay, we have types of business transaction. So variety of business transactions. Cash transaction, a financial transaction settled immediately by paying or receiving cash is a cash transaction. So it is finished then and there. For example, purchase goods of rupees 1000 in cash. Purchase goods, so goods have come in the business and the cash has gone out of the business. So cash transaction is settled immediately because of payment or receiving of cash, and no need to remember the name of parties, because even if it was said that purchase goods of rupees 1000 in cash from Ram, I would not have remembered the name of Ram for recording in my books of accounts, because what have come in is goods and what has gone out is cash. So no need to remember the party's name. That is your cash transaction. Now about credit transaction. A financial transaction in which it is promised to receive or pay later is a credit transaction. Okay, it has entered into place right now, but the payment has not been made or the receipt of cash is still pending. Then such transaction in which the cash portion has to be done afterwards is known as a credit transaction. Example, purchase goods from Ram on credit. So I have purchased goods from Ram, but then I will pay him later on. So it is a credit transaction. Now I have to remember the name of Ram, because ultimately to whom I will pay? To Ram. So Ram is my creditor. Now I have to pay him somewhere later. Now your external transaction. Transaction entered between own business and second party. There has to be two parties, and one is the business itself and other is an outside party. Such transaction entered is called as your external transaction. Example, rent paid to landlord rupees 3000. So your business is paying rent to the landlord. So one party is your business and the landlord is the outside party. So external transaction is when the transaction is entered between your business and your outside party, then it is called as your external transaction. Now internal transaction. Transaction which does not involve any second party. So say I charge depreciation on my machinery. The machinery is with me and depreciation I am charging to get to know the correct profit or loss of the business. So where is the third party involved? There is no other party involved. It is my machine and I am charging depreciation in my books of accounts. That such kind of transaction will be called as your internal transaction. See, the example given here is depreciation charged on our own building held, so which does not involve any second party, that is business and business. Some part of business, say machinery, is affected, and some part of business, that is depreciation, is affected. There is no other outside party. Such transaction which does not involve any second party is called as your internal transaction. Now, very important point, receipts. Meaning, amount received or receivable for selling your assets, goods or services. Okay. In normal course of business, I will sell my products. In maybe not normal course of business, but otherwise sometimes I have to sell my assets. Say land and building is my asset, furniture is my asset, machinery is my asset. What all a company or a firm holds for more than a year is called as a fixed asset. So when I am selling something and an amount is received, that is the transaction has been already settled through bank or cash, or the transaction has been entered into and it will be settled later, the amount is still receivable for selling assets, goods and services. So I have majorly two types of receipts. One is your revenue receipts and other is your capital receipts. So what is revenue receipts? Received in normal course of business, that is your day-to-day work. It is included in your day-to-day transaction, sale of goods, sale of services. So if I am a cement vendor, so my day-to-day work will be sale of cement bags. So in normal course of business, when I sell cement bags, I get some money. So that is my revenue receipts which happen in my day-to-day business. On selling goods, I am getting something. So this is your revenue receipts. Now what about your capital receipts? Whatever receipts other than your revenue receipts, are your capital receipts. You don't get them in normal course of business, that is every day you are not getting them. Let's see the example. Received for transactions other than revenue in nature. Okay, sale of land and building. Do I sell my land and building on a daily basis? This can happen only if my business is to sell land and building. Okay, I am a broker, say. So then that will be revenue receipt. But for other organizations for whom land and building is an asset, not a stock, for them sale of land and building will be your capital receipt. This is a very important point and should be cleared right now, because on basis of this you will have to pass journal entries that will later affect your profit and loss and your balance sheets. So summing up, revenue receipts, the receipts which you get in your normal course of business. Examples, your sale of goods, sale of services is called as revenue receipts. And what are capital receipts? The receipts other than your revenue receipts. Example, sale of land and building, which I normally don't do on a daily basis. From them, if I have generated some revenue, that is called as capital receipts. Okay, income versus revenue. At one glance, for a starter, it is very difficult to make what is the difference between your income and revenue. But as an accounting student, there is a lot of difference between income and revenue. So what is the revenue? Revenue is your gross receipt. That is, once you have sold something, whatever is incoming is your gross receipt. That is before deducting any expense. Revenue is your gross receipt before deducting any expense. And when does revenue becomes income? From your revenue, when I deduct the expenses in your normal course of business, that is net. When the gross turns to net after deducting your expenses, then it is called as income. Did you get my point? Whatever is gross, raw, just received for say sales, for your services provided, before deduction of any expense is called as revenue, and from revenue, when you deduct the expenses, then it is known as your income or your profit. And this is what we exactly do while making a profit and loss account. We first take the revenue, then we deduct all the expenses that are direct and indirect expenses, and ultimately we reach to a net profit, which is called as your income. Okay, profit. I told you that there is a difference between profit and revenue. So let's talk about profit. Income earned from day-to-day operations of business. As I told you earlier, if my business is to sell cement bags, then I will generate profit from selling cement bags after deducting the expenses. So let's learn more about it. Types of profit. Now what are the types of profit? One profit is called as your GP, that is your gross profit, and the other is your NP, that is your net profit. So revenue from sales less your direct cost is your gross profit. I will give you example. Say for 100 rupees is my sales, okay, and my direct cost, say whatever direct costs are, say it is 30 rupees purchase, 10 rupees of your wages and salary, and 10 rupees of your factory lighting. So 30, 40 and 50. 50 are your direct costs. So my gross profit will be 100 minus 50, that is 50. After having the revenue of sales figure in your hand, just subtract all the direct costs, whether it is wages of your labor paid in a factory, whether it is your purchases, whether it is any cost which are directly related to your production or to your factory premises, say carriage in words, that is expense of bringing the things into your factory. Whatever are the direct costs, just reduce them, and the balance what you get is your gross profit. Okay, then what is your NP? Your net profit. Revenue from sales, say it is 100, and direct cost I take it as 50. Now subtract further indirect costs from it. Say whatever are the office expenses, printing, stationery, your lighting, electricity, manager's commission, your refreshment expenses, provident fund expenses, anything, any indirect expenses has to be subtracted. So let's say it is 20. So what I will do is 100 minus 50 minus 20. So that comes to 30. 30 will be your net profit over here. We will discuss about this in very much detail when we do the practical questions. Okay. Gain versus your profit. What is gain and what is profit? Again, for a layman, both of them are same, but for you as an accountancy student, no, there is a difference. So let's read more about it. Gain. Profit from irregular or non-recurrent activities of business. Okay, so the activities which do not relate to your business of day-to-day nature. For example, gain upon sale of fixed assets. My fixed assets written down value is 100 and I am selling it for 110. So 10 is my gain. But do I sell assets regularly? No, I don't. So whatever I am receiving from sale of fixed asset is my gain. What about the profit then? Income earned from day-to-day operations of business is called as profit. Now the cost price of my cement bags is 100 rupees. I am selling them at 110. So my profit is 10. The figures are same, but one is called as gain as it is not from your day-to-day business activities, and one is called as your profit because it is from your day-to-day operations of business. So this is a difference between gain and your profit. Expense. Another very important topic, expense. What is expense? Why do I need to spend only something? I need to spend something in business because I want to generate revenue. So, an expense is cost incurred for generating revenue. Whatever cost is incurred for generating revenue is your expense. Let's learn it with some examples. Payment of salary. I need to pay salary in order that my business is running smoothly. Your telephone bill, your cost of goods sold, writing of part of fixed assets, that is depreciation. All these are my expense needed to be recorded in the books of accounts. So expense is your cost incurred. It is an out of pocket expense. Cost incurred for what? Ultimately, for what are you doing it? For generating revenue, in hope that I will gain something, there will be some income, that is in order to generate revenue, whatever cost is incurred, that is called as expense. Now very important point, please pay attention. An expense is always debited to your profit and loss account. We will learn in later slides what is a debit, what is a credit, but here for now remember that an expense is always debited to your profit and loss account. Why and how is discussed in details in the later slides. Since we have learned about expense, let's learn about type of expenditure. What all types of expenditure can I make in a business? First of all, capital expenditure. Second is your revenue expenditure. And third is your deferred revenue expenditure. Okay. Capital expenditure incurred to acquire any asset or improving existing asset. For example, say for production of cement, I need a special kind of machinery and I purchase that machinery for 1 lakh. For 1 lakh rupees. So this expense, machinery is my asset. So this expense to acquire any asset, which is machinery in this case, is called as your capital expenditure, not happening in regular course of business. Okay. Say I have already a machinery of 1 lakh. Now some part in market has come which will increase its productivity. Say my machinery can make 100 tons of cement in a month. Now if I put some special part to it, it can produce 125 tons of cement in the same month. So since the productivity of the machinery is being increased or improved, that is, the existing asset is being improved, then the part, say additional cost of that part is 2 lakh rupees. So my capital expenditure will be now 1 lakh plus 2 lakh, that is 3 lakhs of rupees. Now you understood what is your capital expenditure. Any expenditure incurred to or acquire or made to acquire a asset or improving the existing asset is your capital expenditure. So what is the revenue expenditure? Let's talk about revenue expenditure. Benefit of which is taken within one accounting period. What is one accounting period? That is, it generally is of 12 months. That is 1 year is your accounting period. So give me examples of revenue expenditure. I say electricity bill, the salary paid, the wages paid, refreshment expenses, your printing and stationery expenses, whatever can be exhausted in 1 month, 1 year's time, that is 12 months period, is known as your revenue expenditure. That is, benefit of expending this is taken within 12 months. And we know that it is written as debit in your P&L account. In the debit side of your profit and loss account, you note revenue expenditure. Again, debit and credit will be discussed later in lot of details. So till now you must have understood that expenditure to acquire an asset or to improve the existing asset is called as capital expenditure, and expenditure benefit of which is taken within one accounting period, that is within 12 months, is known as your revenue expenditure. So what is deferred revenue expenditure? See, some expenditures are in nature of revenue expenditure. Say advertisement expenses. I do advertisement to increase my sales. So generally it is a revenue expenditure that the benefit is taken within 12 months, that is one accounting period. But sometimes what happens is, to establish a product in market, I do such heavy expenses that they will not give me the benefit in just one accounting year, maybe for the even next 4 coming accounting years, that is total 5 accounting years. So the expenses, although revenue in nature, but that don't exhaust within one accounting period, are known as deferred revenue expenditure. Let's read on. Revenue expenditure in nature. What is the nature? The nature is of revenue expenditure and not capital, but written off in more than 1 year, as benefit will be received over years. It is not finished in 1 year. Due to heavy advertisement, see, my product will be sold not only in first year but also for the second, third, fourth and fifth year. So I need to proportionately take them to 5 years. Example, heavy advertising expenses that will give benefit over years is known as your deferred revenue expenditure. We'll learn the treatment, how to put it in your accounts when we do the practicals. What are liabilities? Again, a very important point. The amount which I need to pay to the outsiders is called my liabilities. So liabilities is equal to amount owed payable by the business. It is payable by the business. What kind of liabilities can be there? Internal liability. See, the owners put their capital in the business. So business and the owner or business and the proprietor of the business are two different things. So one side of liability, the main side of your liabilities in your balance sheet is your capital. Liability towards owner of the business is the internal liability of business, because the owner has invested in business in form of say cash, bank balance, building. The owner brings everything to the business so that business has a platform to work. But whom does it belongs to? It belongs to the owner, and so the business has the liability that from those assets invested the business should earn, and there should be some benefit to the owner of the business. So there is an internal liability in form of the capital invested by the owner of the business. What is an external liability? Obviously, as the name suggests, external liability is the liability which has to be paid to the outsiders. Example is your creditors, your bank overdraft, your borrowings. I will take them up one by one. Say I purchase goods on credit. On credit means goods have come into my factory but I have not paid for them. So one day I will have to pay for the goods which I have purchased. So the person to whom I need to pay is my creditor, because I have purchased goods on credit. So when I need to pay to someone, they are my creditors and they will stand in liability side because I need to pay them one day. So as it is outside the organization, it is called as external liability, and creditor is the person to whom I need to pay. Okay. Now your bank overdraft. All of you must have seen a bank passbook or a bank balance. When you withdraw more than what you have in your bank account, then it is known as bank overdraft. Bank charges interest on it. And say I have 1 lakh rupees in my bank, but I am taking out 1,10,000. So 1,10,000, out of that your 10,000 is your overdraft. 1 lakh you had and 10,000 you are withdrawing more than what you have. So it is a liability to pay to the bank. So it is known as bank overdraft. Now borrowings. Borrowings also, I can borrow from the bank or any other institution, but I will need to pay it in coming future. So that is my liability. Anything which I need to pay to anyone is my liability. In nutshell, anything. For stock purchased, you have to pay to creditors. For bank overdraft, you need to pay to the bank. For borrowings, you need to pay to the lender of the money. So anything which you need to pay is your liability, and when you need to pay it to outsiders, it is your external liability. Okay. Now as per term, let's divide the liability as per your term. Current liability and long-term liability. What is current liability? The liability which is payable within 12 months of period is known as your current liability. See, I need to pay creditors within 12 months. My bills return. So bills payable, that is a short term time is given, not over 12 months, so it is a current liability. Short term loan, again your current liability. Outstanding expenses, that is expenses which are due but not paid yet. For example, salary of an employee that he has worked for the month of March, but I am paying to him in the month of April. So in the month of March it is due, but I am not paying to him right now. So it is outstanding expenses, which is my current liability. Long-term liability, now which is payable for over 12 months, is known as your long-term liability. Example is your long-term borrowings, which I need to pay over than a year, are my long-term liabilities. Okay, system of accounting. Our accounting is totally based on double entry system. The Indian way of accounting is double entry system. Now how does it work? See this T shape of account here. This is called as T shape of account. One side is your debit side and the other side is your credit side. So, both debit and credit aspects of accounting are recorded. That is, it has a dual aspect. See, in maths, 2 plus 2 has to be 4. Same way in accounts, for every debit, there has to be an equal and opposite credit, and then only your accounts are tallied, otherwise there is a mistake. So accounts is as good as mathematics. If you are good with debit and credit, nothing can stop you from being good at your accounts. So understand the debit credit concept very well. Let's proceed. Total of debit is equal to total of credit. See how left hand side is debit side written as DR. So my left hand side is the debit side, my right hand side is the credit side written as CR, and here I write the name of the account. Say it is a salary account or your advertisement account, whatever. So for now, just remember that one side is debit side, which is the left hand side, and the other side is the credit side, which is the right hand side. And for every debit there has to be an equal and opposite credit. That is known as your double entry system. So what is a single entry system? Single entry system. These are accounts from incomplete records. Now, someone has not maintained the records on double entry system, the accounts are incomplete, and now he needs to know what capital has been invested in, what is the profit I have earned or what loss I have made over the years. So what he'll do, he'll take the help of single entry system. That is, this is covered in totality in your chapter of incomplete records, but for now what is the theory regarding it? All transactions are not recorded on double entries basis, so they lack transactions being recorded on your double entry basis. In some transactions, both debit and credit sides are recorded. That is, they keep on dual entry system type of accounts, whereas on the other transactions, they record only one aspect of the transaction. Either they will record the debit and they will leave the credit, or they will record the credit side and they will leave the debit side. That is, only one aspect is recorded. Or one more final situation is that they don't record it at all. So from that, how do we get to know our profit, our loss, my capital? That has to be derived. That all we will do when we do the practicals of your incomplete records. But now know that what is double entry system. For every transaction there has to be a debit and a credit. That is your double entry system. Very important topic, assets. What are assets? Assets are actually what helps you in smooth running of your business. Let's discuss it in much detail because this will keep coming everywhere. So, one is tangible asset and the other is intangible asset. What is tangible? Assets which have a physical existence, which can be physically touched, can be felt, are known as your tangible assets. So let's read the meaning. Assets which have physical existence, that is, which can be seen and touched, are called your tangible asset. Okay, the example is land and building, plant and machinery, furnitures, investments, debtors, cash, bank, inventory, that is your stock. Inventory means your stock. Okay. So some assets have existence for over 12 months, that is one accounting period, and some have existence only for 12 months. So the assets which have existence for over 12 months are known as your fixed asset. Say land and building, plant and machinery, furniture, investments over 12 months, all these are your fixed assets, whereas assets which have the life of generally 12 months is known as your current assets. For example, your debtors, they will keep changing within 12 months. They will not remain the same. So they are known as current assets. Your debtors from whom you need to take money. For sale of goods, you need to take money from them. They have purchased from you on credit. Now they need to pay you. So their debtors are your assets. Cash, your bank balance and your stock, that is your inventory, will not remain same for the 12 months. It will keep changing. So they are your current assets. This was about your tangible assets which can be touched. Now, intangible assets. Assets which do not have physical existence, although they are of great value. Say name, in name only there is so much of value that because of that name you will get business. But can you go and touch that name? No. So goodwill of a business, a trademark, a copyright, a patent, they don't have a physical existence, but still in big business houses they are of great value. Say for example Tata, Birla, your Reliance, their name is only of such a big value, that is their goodwill. So their goodwill asset will remain in crores and crores of rupees, although that cannot be physically touched. So the assets which have an existence but not a physical existence is known as your intangible asset, that is your goodwill, trademark, copyright and the patents.